Buonasera, Carlos Irtates, O Economica. Welcome everybody to O Economica. Happy to be with you all today. I hope you're having very good holidays and you are enjoying this summertime. And as usual, today I'm back with very interesting content, a lot of things. And I was wasting my time just checking a few charts or stuff like that. I'll start with charts now, so that will be a bit more interesting, the first few minutes of the content, and then we will proceed with the behind the scenes working with the data. So I can anticipate to you that I will run a thorough analysis, data time series analysis of all the majors, the largest European stock market index. That would mean the DAX, the FTSE, the IBEX, the FTSE MIB, the CAC 40, the Sweden OMX, the Norway's the Norwegian benchmark, the Danish benchmark, and yeah, more or less it's about a little bit more than 10 or 12 large index benchmark with the Vix. And I hope many of you have watch my short clip on the Vix Term Structure. I will show you some very interesting stuff that I can work with. And so let's get on with this thing. So basically technical charts are useless. They are not worth the time people spend on, but there are a few things which are very important, which are not, of course they are not on the charts, and it's volumes, order books, order flows and stuff like that. So those who do professional prop trading, they know that they need to see what are the volumes, the order book, the order flows, and the different levels of orders in the market. And of course that data is not complete. It depends from which exchange you get the data, what is the provider. You don't have the data from the dark pools and stuff like that. So markets, they are not efficient, and so we can just put aside the concept that markets are always perfect and efficient and we all have the same information at the same time. That's not true. And so again, another concept, that charts, like trading charts, they are perfectly useless, because people who do this for work, they work at investment banks or hedge funds, they don't of course they have the charts in front of them, but what they monitor all the time is the order flows, the books, the volumes and stuff like that. So the basic thing that anybody can do on TradingView, and all the people do that, is to take the volume profile, which only works with the only works backward with older data, but there are a few things that we can learn together. Is something that I learned myself by trying to understand what to do with the volume profile. Okay, the volume profile works with the alphabet, okay, which is not Google. It works with B, D, and P. Right, okay, so now we see here, we have this very long volume profile, and we have this sort of the long black line. It's the area where is the area where in that month, okay, sorry about that, in that month or in that period, we have the largest volume of transaction which are transacted around the 18,490 points for the DAX in that period, which is in this period here from what is that? Yeah, from April 2024 up to, I don't know, August 2024. Okay, let's say between the second quarter and the third quarter. So if we take into account the black line, we have a sort of B, which is more of an L rather than a B, but the correct way to read the volume profile is to trying to extrapolate what letter of the alphabet we have, and that will give you the trend. Okay, so here we have the volume profile. So also here, for example, yeah, let's say that the volume profile with the maximum point of control, which is here, let's make a B, which is for buy. In fact, we see that the trend goes up until it goes here, okay, and we have the point of control in the volume, which is smack in the middle, more or less. It means that we are in balance between the upside of the distribution and the downside of the distribution. And we could we can take, I'm sorry for, I apologize to all the people who are technicians of volume profile. I'm just doing a bit of mumbo jumbo. So here we have an area of balance in the middle, and we can say that this one is letter D. Letter D means that we are the trend, the following periods in the price action will be balanced around a certain range. Okay. So the volume profile basically helps us. Here we have a very big B and we have a long trend uptrend. Okay. So more or less it's the basics, B for the basics of understanding the volume profile. Although here I think it's more of a D. Yeah, because we have the point of control which is in the middle, so we are balancing in this area before going up. Okay, we have the breakout. So in technical terms for the chart. So what is how to use the chart? My humble suggestion is at least to have the volume profile. If you have, and two basic requirements are volume profile and order flows, or the order book, so that you can see anybody if you are the viewer of the video. So the must have for a technical chart are volume profiles, so the volumes, the daily volumes, the intraday volumes, and the order flows. Most of the people know this. Other people, they may not be aware of this stuff because these indicators, they are not available for any kind of platform or software that you want to use. And the method to utilize the volume profile is with three letters. I just said it's B, D. I cannot get rid of that. Sorry, mumbo jumbo with the chart. B, D, and P. Okay. So we know that B stays for buy. D is for balance, so we are trending within a range. P, it's basically, it's let's take an offer is for put. So that means that when we have a volume profile like this one here, P, it means that we have a top in the distribution, and the stock market in the following weeks or months or quarters will go, the distribution of the volume of transaction will be to the downside. So the market will start to basically, there will be a market for the DAX, and in this case for all the 40 stocks that are listed in the DAX, of prices which are not going, let's say not going up or drifting higher, but they will be going down. So the market will be trading the stocks and the index for prices that have been already traded. So that's the mechanism of price discovery or mean reversion. So investors, they probably, there are so many things at work because there is portfolio rebalancing, there is option expiring, there is the business cycle, there is the long-term cycle of the market, and there is the day-to-day interaction, like the zero-day option expiry and stuff like that. So there are huge volumes in the market, huge amounts of liquidity every day. And so what it means, there is no particular meaning because it's not, it can be expressed in words. What basically we see when there is a sell-off or a correction is the market made of people or algorithms. They do transaction with prices that they have discovered before in order to understand what is the fair value of the market considering all the other circumstances. And the volume profile can help us understand in which phase of the distribution of daily volumes of transaction the market is moving. So if there is a B, that means there is a buy, we have a lower point of control and all a distribution that goes up, so the market is going up. So we have a distribution of volumes of transaction for prices which are above the point of control, which is here. So naturally we can understand that if we start from 18 18,400, and then we go and exchange price for 18,500, 600, 19,000, 20,000. The market, it's working with prices going with higher prices. So higher prices are clearing higher prices. Okay, when we have a volume profile which seems be shaping a sort of P, that means that the market will be clearing prices with lower prices. Okay, we have lower lows, lower lows, lower lows, or the market tries to find what is the fair value in that circumstances. And the price action in the market is, as I said, is determined by institutional investors, institutional flows, ETFs, options. Are we in the earning season? So there is a portfolio rebalancing because it's end of quarter, or there is option expiry. There are loads of things going on, and so the basic stuff that anybody wants to approach a chart of the stock market, it's basically at least to have the volume profile, to know the volumes, and to have the order flow, the order book, in order to have a more or less, to have a more precise idea of what is going on. Because as long as you are sitting at your desk staring at the green, red, green, red, green, red, whatsoever, what is the shape of the candle, is a bearish engulfing. The Japanese candlestick method, it's wonderful. It's the first technique that you can learn, but it's not the all and everything, because you need to know what are the volumes and what is the order flow in the market in order to understand where potentially the market is going, so that you can have higher probability in placing your bet, your trade in the right direction, that and lowering the probability that you place your trade in the wrong direction. Okay, that is in trading terms. So yeah, volume profile is the minimum, or Fibonacci, etc. You can use all the indicators that you want, but in my world, the technical charts, it's pretty much useless unless you you use the chart with the volumes and with the order flows. So having said that, now we can see here, for example, that while I try to erase all these letters and stuff like that, the DAX, DAX index, same as all the other stock market indices, like also as the S&P 500 or the Nasdaq or the Dow Jones and all that stuff, they've been very extended in their uptrend. So the market for a very long period, or not very long, some long, short, it depends, for some considerable period of time, it can be a medium cycle 3 to 5 years, or a long cycle more than 10 years, the market has always been clearing higher prices with higher prices with higher prices, and contextually we are experiencing higher inflation and higher inflation and higher inflation, which is it's not a coincidence. So the stock market is not the economy is not the stock market, but asset prices inflation, it's a very correlated factor to ordinary goods and services inflation in the economy, and also the demand and supply in the economy. So what we see here, so basically, is that, okay, let me I want to just make sure that you can all see. Okay, I think we can all see here. Okay, let's do the chart technicians, and let's put the dots together. Okay, again, here we have point of control here, so we have a B, and the market goes up. Okay, it goes up to here. We have a volume profile distribution. The point of control, it's more or less in the median, not really in the median, it's more skewed to the upside. There is a slight skew of the distribution, but let's say this is a D. So it means that the market has cleared to the upside by the volume of transaction. It's already anticipating that the following distribution of volume of transaction will be potentially within a range. Okay, so in fact, from here to here, we have largest volume here, and we have lower volumes here. The point of control is here, at the top of the distribution. exactly at the all-time high. And we can consider this as a P. So that means that the following period, there is a very good probability that the DAX, the market of the DAX in itself, so which is 40 stocks, 40 blue chips of the German DAX, will start to clear prices going to the downside with lower prices. That will be the price discovery mechanisms in the market. Why? I don't know, for macroeconomic reasons, for valuations, I don't know, we have price to earning multiples which are very, very high. And another factor is here, we see here the relative strength, it's 79. So people, they use 70-30 as relative strength, I use 80-20, I make it very, very large, because I prefer to see, I know that the market always goes overbought or oversold, it's very, very large, so for me it's pointless to see it's 70-30, I don't mind. But nevertheless, it's almost overbought, more than 80, okay? So if we see here, we are very, very stretched, and those candles, the body of the candles is very, very small, so it's a doji. So here we have this one here. This one, it's technically called an hanging man, okay? So basically, we can see here that the price action, it's performing a oh dear, it's a curve. So basically, the market is taking the point of the derivation. We are deriving the price. We are at the local max. Let's call it a local max, because it's not an absolute maximum, because we don't know what is the absolute maximum. Okay, let's get rid of this P. Okay, and probably the trend is it's going to the downside, and we can try and figure out, okay, that's the derivative here, the curve, then I have another derivative here in the curve. Well, that's a secant. Yeah, so the trend, the curve, the curvature of the price action change slope, well, that means that the market will start to clear prices with lower prices, and we have a pullback or a correction or a reversion to the mean. No? So let me just design my P here. Okay, this is a P. Okay, so it's a put option. So you want to hedge your downside risk with put option on the DAX, like plain vanilla puts. I don't mind, you can do it. You are the owner of your destiny. And so we will start to probably in the next, the coming weeks and months, inevitably we will have a stock market pullback or correction which comes up in late August or in September, in October, and the market then is prepared for the Q4 rally. Although then after the Q4 rally with the higher volatility, you have tail build up of volatility that goes into Q1, and then you have January and February and March, which are very, very volatile months in the year, so the first quarter. So between fall and the best period to be long the market, it's from April to July, August. Okay, it's you make the gain basically when after the storm in Q1 and the drawdown in April, because there is tax here, so maybe there are outflows for the market to pay tax or stuff like that. Then let's say from mid-April going into the end of July, mid-August, the market goes up, no problem, no issues. Volatility is contained, is low, there is no much risk in hedging downside, stuff like that. If you have a portfolio of stocks, of course you have to be lucky, and you have to be prepared to know in which stocks you want to invest, if you want to be long some indices or stuff like that. But then in seasonality, in cyclicality terms, then when it starts to go mid-August or approaching September and October, approaching September more or less, there is basically rebalancing of the portfolio. Large institutional funds, they could rotate out of some stocks and then go into cash, and then have some liquidity to then participate in the Santa Claus rally, in the Christmas rally and stuff like that, which is absurd to talk about Christmas when there are when you are in Greece with the Uzo, yo, Kerry, yo, cow. they are in Greece with a bottle of ouzo at 45 degrees or 50 degrees, and you're thinking about Christmas. That's insane. But basically, so the cyclicality in the market, you have to know when August is low volumes and there can be already spikes. Like for example, the Asian markets, they can be very volatile because there is low liquidity. Europe, it's sleeping, and the United States also, it's very low liquidity. So Asian markets, they can be very volatile, and there can be liquidity issues during the Asian session. So what I'm saying is that only by checking the charts, taking the volume profile, and if you want to be like the day traders and say, okay, the DAX is going somewhere, probably there can be a retracement. At least take this volume profile here at 24,250, and then we go back down here to what is the price here? 22,400, 24,200, so it's around 1,800 points or stuff like that. So let's simulate, let's see, where is the thing? Short position. Okay, we want a short position here. Let's play it. Okay, and we go there. It's like sort of 6% to downside, more or less, taking a risk of 6% to the downside, but then you have basically a stop loss of 3.5%, which is well above the historical all-time high. So maybe, I don't know what is, I don't know what it's, risk reward 1.77. So that's probably a sort of idea of doing some stupid things, which I'm not gonna do that, of course. But so basically what I'm saying is that, as I'll say it again, the minimum requirements is the volume profile and the order flows, and then just watching if it's the bars in the chart there, it's pretty useless. Also the indicators, because you see here the RSI is from January to to August, it's been 8 months, which is overbought, above 70. So probably you can go short in January and you are offside for the whole year. So also the RSI, it leaves the time that it takes. It's not very meaningful. Okay, so those are the maybe the basic things to understand a little bit what is the stock market. And as I said, when you see a price, now it's 22 or something, you know that the price, it's an average price at time t plus a volatility component at time t, okay, which is an h, it's not a t. Okay, I was trying to do the brackets, yeah. Let's call it the brackets. Oh, that's a bracket. It's more quantum mechanic bracket. Okay, so the price basically at every minute, milliseconds or stuff like that, every hour, day, months, every time frame that you want, the price is the price that you see in the market is the expression of the average price plus some volatility, some drift of the volatility. Okay, so we can basically presume or start to figure out maybe there's going to be a correction, because usually when it's late August or in August itself and September, October, you have portfolio rebalancing, and then you have a pullback in prices, and then that creates the speculation opportunity. When you have lower prices, you have a short-term speculation opportunity going into November and December, and the rally of the Q4. But it's a very short time frame, because then from Q4 you go into the first quarter of the year, and it's also very, very volatile. So it's very, very difficult to manage if you have a portfolio, and it's something that I don't do as a saver or I'm not an equity portfolio manager, not at all. So okay, so let's consider that probably the DAX is a bit overbought, it's a bit stretched to the upside, and we see also from the volume profile and the trend, it's going in some downward direction, which is not going to be tomorrow. The chart here, it's a month chart, so probably next month, or it takes time. It's not something that is going to happen the next minute or overnight. But nevertheless, another thing to consider, I would like you to see, if I can get rid of the volume profile. Okay, let's do like this. Remove. Okay, yes. So you see here how the recent past trend here, this one, it's sort of very exponential, sort of differential equation. So you mean that you have an exponential time component, not an exponential time, you have an exponential component into the drift term, into the average for the price discovery of the market. There is an exponential component in the price discovery of the market, and you have this uptrend is very, like, really an exponential function. So those are the sort of most dangerous things, because it seems that it only goes up, and then you see that then it bumps here, and it's very visibly turning down. It's a bit like me. It's a bit struggling here, but you see that the body of the candles are all smaller and smaller and smaller, and so there is not much volume going into the buy side of the market, and there is some hesitancy, some uncertainty in the path forward. Okay, and that reflects exactly what the volume profile would basically tell you. The data and volume profile will basically inform you that, okay, if you have a B here, we buy here, and then we balance here, and then we put here, and we go down, because we need to know where the investors stand in the, not where the investors stand in the market, what is the fair value for investors. So there is a price discovery, prices are cleared with lower prices. So having said this, we can see also here, you see here what spectacular geometric work I have here. Here you can see this very nice geometric shape here. So all the people that love technical charts here, see what is the parallelogram here. Okay, so this trend here is boxed in. If you are here, then there is no way you can go up or down, and then you're boxed in here, and then it gets narrow and narrow. Okay, I don't, it's just a joke. See, but I've designed a perfect parallelogram, so we know the angles, and we can do some nice geometry and stuff like that. So basically the FTSE 100, it has spent a very long time in this very secular cycle here. Okay, we can design the cycle. Okay, and we can see here that the periods here, they are shorter and shorter. So this then here we have a very large amplitude here, this area. Here they are shorter, so the frequency is they are the up and down of the price action. They have much shorter amplitude. There is more frequency in the upside and downside, so there is more volatility, which is short-term volatility, which reflects also the business cycle and the volatility in the economy and all the other exogenous factor. So also means that here we have a long period of expansion, and then we have a recession, which is a whole business cycle. The same is here, but we see that the amplitude here, we have another very long period, but now we are in a shorter volatility period, although we are going up. But basically that reflects the, as I say, the business cycle, and also the investors' behavior, the market behavior for their allocation in the FTSE 100, which only lately here, finally, after many years, basically from here to here, we broke, we have a breakout to the upside, going to the 9,000, and probably it will be 9,500, 9,400 and something, before the investors, they start to pull back, because probably stocks, they are very much overpriced with respect to what are the dividends or the earnings per share and stuff like that. So we can see here how, even in the charts, how different are the business cycle. What is the DAX, the GDAX, the cycle, the cyclicality in the stock market, whether it's the DAX or it's the FTSE, or it can be the let's see, the French stock market. Okay, or the Italian stock market, FTSE MIB, which is supposed to be Euronext. It's not supposed to be FTSE. I don't know what they. So that's the basically that's the benchmark FTSE Milan stock exchange and stuff like that. And in the previous weeks I said, okay, be careful when the market here goes to 40,000, and we are against. Now we are against. Basically, the market is pinching on this Fibonacci retracement, the 0.786. It's 41,015, and basically if we take the timing of the market, if we get it right, we see here that we have a top here, this dangerous area, and same the DAX also is building up a sort of a curvature and a derivative effect of a local max, and then we have a second derivative effect, and then the market starts to drift to the downside. So we have a confluence of factors. And in my other video I showed basically, like for example, as Kering, which is a luxury stock, is very, very volatile. I would never invest in Kering. And yeah, the possible scenarios of a 15% pullback, even 30% pullback, or stuff like that. That's basically charting things. We can see here the French stock market CAC 40 is very similar to the FTSE 100, to the UK stock market. It's a cyclicality, long-term cyclicality, and we see here how in the short term we are also the French stock market, the frequency of the trades, the cyclicality is shorter and shorter and shorter. So we have a lot of short-term volatility. Let's do it again here. And then here we have very close, very narrow bell curve, another very narrow, and here we are very narrow again. So there is a lot of short-term volatility, so a lot of higher volatility, because in a very short term we go up and immediately we turn down again. So the market is bumping up and down, up and down, up and down, and but nevertheless it managed to grind higher, it manages to clear with the higher prices. And here, for example, we see how the RSI is very counterintuitive. So it's 52. So it's nevertheless that the French stock market, it was at all-time high at 82.59, and now it's 600 points below. So there is already a pullback in place. But the relative strength index, it's just in the middle. There is no much strength, not much weakness, but there can be more weakness in the coming weeks and months if there is, or when there is a basically a retracement in the market. It can be here about 6,500, or here like the past all-time high. I mean, with charts you can do all sorts of geometry curves. You can do all the squiggle and squaggles and all the design that you like. You can design Louis Vuitton. I don't mind. You can design Kering, Gucci, Prada. You can design Levi's, or I don't mind. You can do all the sorts of squiggles that you like. What counts is the volume. So let's see the volumes. Okay, and then we will start with we don't have volumes here. I don't mind, honestly. We start to crunch some numbers. Okay, so here that's what technically in the chart is called a double top. So basically we are hanging around these levels, and then come September, October, probably we will have sort of this same pattern. It depends how deep is the basically the repricing of the market and where is fair value in the market, which is not much speculative. So how do we go about the stock market? So basically what I do most often than other things, I basically build for myself a lot of models where I find the most volatile points in the return distributions, what are the most like the black swan scenarios, so when the market basically, when you have a big sell-off in the market, like panic and all the newspapers and the market is tanking 5%, $1 trillion goes up in flames in the market, and then the market is tanking for some sort of reason. So what do I do in my work time? Because it's my work study time. I'll take a sip of water. Wait a minute. Okay. Is to build my risk management model. And I do it mostly for study purpose and also for data, so that I have my own back data engine of stuff that I can update every day. You just click run all, and then you run the model every day in updates all the time. So basically, okay, we can jump. We know that returns are not normally distributed. So let's no, I cannot run the model now, but otherwise it's going to be a problem with the recording. So okay, we can see here what are we checking now in the stumbling and mumbling and mambo jumbo. Okay, so what did I pull together? DAX, the CAC 40, the Vix, the IBEX, the FTSE 100, the Euro Stocks 50, Belgian stock market, the Amsterdam Stock Exchange, the Swiss benchmark, then the Norway, Sweden, and Denmark benchmark, the Nikkei 225, the Austrian also index, and the FTSE MIB. I forgot about the Polish stock market and some others. I think I have also the Portugal benchmark, but for practicality, and also because I really forgot about Poland stock market, I should have included it. Anyway, so GDAX rolling volatility. So we start to go with the volatility, which is the most important first measure that we need to know. And here, annualized vol, we see how in the past period, the red line has changed slope, it's sloping upward. Okay, so we have a general convexity in the curve, and the annualized vol, it's basically between it's between 15 and 20%, around 17%. I will have the exact data in a while. And so that's the first thing that can tell us, okay, we are in a quiet period, or underneath the market there is more volatility. So basically the price discovery, the price action in the market is more volatile. So there are investors who are buying, but there are also investors who are selling, because for a buyer there must be a seller, for a seller there must be a buyer, otherwise there isn't a market. That's simple. And so here in the rolling 7 and 21 days volatility, which is the short time frame, we are still in the 1% daily volatility, but nevertheless, in the beginning of 2025, we have here, we have had a higher spike in daily vol. Okay, panic bottom. So in the beginning of the year, yeah, if we see the yellow and the green line, we remember easily we had a correction in the first 3 months of the year. Then comes April, mid-April, you start to buy, and so that it is reflected in the higher daily volatility. It can be as high as 3%. So that's the yellow line here is very similar to that period here. So we see that volatility patterns, they tend to be similar, of course, because the data it's has a sort of cyclicality in itself. So here, for example, we see the rolling volatility in the VIX, and in the past period we have been experiencing, although the market has been going up, underneath the whole movements in the market, what investors do, etc., VIX annualized volatility has been much higher. So that is basically a it's an alarm bell for those people who say, okay, no, the market's going to go up, it's going to go up no matter what. Actually, the volatility in Vix, which is the volatility index in itself, has been much higher. It has been building up. And usually, almost certainly, when you have a build-up of volatility, then it doesn't fade away and it disappears. That's not how stock market works. That's not how volatility works. So when you have a build-up in volatility, then you have some stock market event or correction, okay, which are consistent with the many data points that professional investors, institutional funds or hedge funds, they have to pull together in order for their risk management and stuff like that. So the IBEX also, we are in the same range, for example. So we are realizing that basically volatility could be going up, could be increasing a little bit for the indices, broad indices, although we see the market going up very easily every day, but underneath also there is a build-up. There has been between 2024 and 2025 a build-up in volatility for the VIX, the volatility index in itself. And okay, I want to show you, no, I will show you later. I will tell you another thing later about when we analyze the Vix Term Structure. You can go and check the, I have a short video about the Vix Term Structure, and you can probably, I will put a card here, you can click on the link. So the Vix Term Structure also, the data which are in the market, we see that the Vix curve is in a contango, exactly as this red line. So we have shorter, lower price. The VIX today is pricing, I don't know, 20. In next month, the VIX future is 21, 22. So the curve, it's upward sloping. So there is a contango. So the market is already positioning, expecting or hedging for higher volatility in next quarter up to 6 months in the future. Okay. So there are all the data points which are very useful for from the top investor to the smaller investor to have or the, I don't know, all the ordinary people who have savings in their ETFs and stuff like that. They can phone up their financial advisor and say, oh, switch my ETF or buy some volatility ETFs or something like that. You can play around these things. IBEX, volatility, Spanish equities, we are pretty much the same. All the market, it's been moving up in the 15 to 20%, above 15% annualized vol. That's okay. The FTSE has been a little less volatile. We are between 10 and 15%. Okay, that's the Euro 50, between 15 and 20%. The Euro 50, of course, is very much correlated with the DAX. So it's something that if you are long or short the DAX, at the same time you can be long or short the Euro Stocks 50. They both go in the same direction, more or less, with a different magnitude in the daily standard deviation of the points, but it's the same. Belgian index, also we are around 15% annualized vol, and you see here, oh, that's the AEX, so this is the Amsterdam index, and we see how the blue line is a long cycle of upward stock market trend, and volatility in the index annualized has just jumped up to 15%. So we are in a period of market at all-time high and a bit of uncertainty, and underneath the volatility, underneath the market, the volatility is building up. So that means that there can be a correction in the market to assess what is the fair value of the market. That's the Swiss index, the blue chip Swiss index, and we are above 15% annualized vol. OMX, let me just bear with me 1 second because I'm not so an expert. So okay, OMX Stockholm. Oh, okay, OMXH is the Helsinki, so is the Finnish stock market. Okay, so Finland, Sweden, Okay, if it's true, unless it's the Norwegian stock market. I use the data, I haven't checked probably what I'm talking about. So, also here we are a 17.5% annualized vol. The Nikkei 225, all historical all-time high, and we are at 30% annualized vol. So the Japanese market is very, very risky. It's very volatile. You can see that overnight the market goes up or down easy 2-3% like fresh water, basically. Uh, and then it can be very, very, very volatile, the Nikkei. So OMX C25, this is the Copenhagen market, and we see the blue line, it starts already turning down, and in fact we have some higher volatility. So we are having a capital outflows from Danish equities, the Copenhagen OMX index, and in fact the red line, we are at 20% annualized vol. Also the short frame standard deviation, it's around 2% daily on a 7-day rolling vol, and what we can appreciate is that the yellow line here, it's higher than the green line. So the shorter 7-day rolling vol, it's higher, it's 2% daily. So short the Copenhagen index, the OMX C25, it has been a speculative activity in all 2025. Okay, that's the Helsinki. So I believe probably this OMXS is the Stockholm, so it's the Sweden stock market, probably, I don't know. Oh no, probably it's the Norwegian. I have no idea. Okay. Finnish stock market all-time high, very low volatility. OMX, that's the Stockholm's, yeah, that's the Sweden stock market, also all-time high, and vol, it's approaching the 20%. Austrian stock market also almost at the peak of pre-2008, and we have almost 20% daily vol. The Italian stock market going to record after record after record, and it's 20% vol, so it's not without any calm waters, without any volatility. And of course we can build the what are the black swan days, and we can have our EVT, which is not electric vehicle, but it's extreme value theory and the peak over threshold theory. So we have the value at risk days, and on top of that we have an expected shortfall, so that can basically captures with all the historical data all the extreme volatility days, stock market days for each and every index that we are analyzing. And the DAX, the VAR 95 of the DAX, it's a mere 2%. So a very normal volatile day in DAX can go down 2%. It's almost nothing because it's only a VAR 95, which means again that the VAR 95 defines the 5% probability that in one day I have a loss of 2%, or it can exceed, my portfolio exceeds 2%, or that the DAX has a daily loss of 2% or in excess of 2%. In that regard, then we have the expected shortfall. So the VAR 95, whenever the DAX has a daily loss of 2%, then we are sounds the alarm bell. Okay, it's a VAR 95. What to do? It's just one day, or there is volatility building up, and then we will have more days of very large drawdown in the market. Okay, that's the purpose of managing the risk. And then in the same instance, let's say we have some black swan event. Okay, the stock market open, the DAX is down 2% at the open. Okay, so gap down 2%. So we have also, then we are in the contingency that the DAX has violated the VAR 95, so the 5% probability that in one day it has a loss of 2%, it can exceed the loss of 2%. The loss in excess of 2% is exactly the expected shortfall, which helps us to measure in the extreme value theory. So in these extreme events, which are not ordinary, but we cannot, the worst thing that we can do, that's my personal humble not belief. That's how I approach it, my empirical approach. The worst thing to do is to ignore fat tails, is to ignore the tail of the distribution. Because basically it's the tail of the distribution and the skewness of the distribution that defines if that financial asset or that macroeconomic variable it's stable or not, or it's a good investment or not, if it's worth the risk or not. So that's why I prefer to focus on the black swan events, what are the very volatile parameters, because the day-to-day, the market very calmly grinds higher, I don't mind, but then all of a sudden you have stock market sell-off and you don't know from where it's what's happening. So that's my it's my fault that I always worry for the worst case scenario, but nevertheless, so the expected shortfall is when basically the DAX goes into a daily loss of minus 3.16%. You can all read it here, okay? So you go for the software and then you can build a table that gives you all the parameters that you need to have. And why these parameters are important, they are not the same. It depends. If you analyze the data of the DAX from 2020 to 2024 or up to date, you will have different parameters. It depends from how discrete is the period of time that you are taking. So by no means the stuff that you see here, the numbers that you see here, they are all absolute. No, never, forget it. Nothing is absolute. Forget absolute things. It's just we need empirical evidence. We don't need absolutist dictatorship. You can chuck it in the bin and keep it for yourself. That's rubbish. Also, another important thing is that the distribution, the shape parameter, it's positive, 0. Almost 12. Positive parameter tells us there are fat tail distribution, so there is reasonable expectation of extreme daily loss, okay, for the whole index. And you can imagine, you can figure out that the DAX is 40 stocks. So for the whole index to go down 2-3%, 7%, it means that the market is really tanking. It's plunging with both ends. With investors, they are throwing all the stock out the window. They don't want to know anything about that. So very useful to have these charts. The blue line is the daily returns, and you have the dashed line, the orange and the red line. It's a bit like a traffic light system, which is never. The orange line, the amber line is 95%. So you can see all the blue lines, the daily returns above the orange line. Those are all the days when the DAX has at least made a daily drawdown of 2%, or the loss has exceeded 2%. In the order of 3.1, 2.7%, 4% daily. And then all those blue points, which are over the EVT line, the VAR 99. So we are at the 1% probability to have a daily loss of 3.8%, or in excess of 5%, even 7, 8, 10%, those stock market crashing basically in a couple of days. And so you can see also that on the downside, those are the positive days, because if you see here, we have loss. So all the positive loss is loss, all the negative loss is the gain. It's just a reverse of the percentage change. And of course, there are very large days of gains. So the market can gain 10% in a day, no matter what. So it's true both sides. It's not just one side. A worst case scenario, of course, but nevertheless, I said it's wrong to ignore fat tail events, because they are more frequent than what we want to acknowledge. It's very comfortable to sit in the same construct and have a very chunky slices of German sausage or Wiener Schnitzel or bacon or parma ham on our highs, very chunky slices of bacon on our highs, and ignoring what's going on, because volatility is much more frequent than we actually realize, and especially with the digital stock market, there is much more volatility inbuilt in the market. So here, CAC 40, also lot of VAR 95 days, so it's very easy that the French market, the blue chip French market, with Louis Vuitton, Kering, I don't know, Total, Carrefour, Stellantis, il va là-bas, il va là-bas, ça fonde, le marché, ça va fondre. sorry for my French, but basically it's very easy that you have a VAR 95, you have a 2%, 2.02% daily drawdown. So the market basically erases 2% in one day on market cap. The expected shortfall is 3.2%. So it's very easy to focus on the VAR 95, even the mid-range 97.5. Okay, so it's easy that the French market can have a daily drawdown of 2% or in excess of 2%. Okay, what is very rare, of course, if we are the stock market declining by 7 or 9% in one day. But we have seen multiple times, which is very easy, that equities, the stocks, they move more than 2% in one day, on the upside and on the downside as well. So there is inbuilt downside risk in the market. We tend to ignore because we want to believe that we will be very rich very quickly in a couple of minutes. We will be millionaires because we are betting on the market. So also now it's very interesting. Let's see what happens with the VIX. Okay, so we see that the value at risk level for the VIX, they are very large. So the VAR 95 is 10%, 10.5%. It's unbelievable. Okay, it's huge. And basically what that means is that, of course, the VIX is very volatile, and basically it does not, because it's very volatile, it does not move in a, let's say, steady fashion, but it has more peaks and troughs. Okay, you can have the VIX going one day 40 and the next day it's 20. So there are 15 or 20, 30% move in one day. But that's why the extreme value in the VIX, they are 10, 13, 17, 29%, even 35%, or almost 36% in one day of expected shortfall. Very rare cases can be the market is crashing big time, and you have a VIX value to risk 40%. It's huge. It's very huge. So that's why the VIX trade, it's something that ordinary people tend to ignore, but volatility can be useful if you know how to use it. So basically, if you have I'm sure in modern days, a good method to hedge the downside risk in the market is to be long vol. That's as simple as that. Okay, so if you manage to build some models, as I will show you, and you know when the market is going, when you have potentially you're gonna have a sell-off in the market. Now I will show you something. So basically, working all the VIX data. So I have here a table with all the daily data from 2010 up to August 2025. So it was Monday, and here we can focus on this thing. Okay, so we are here. Okay, what the model tells me, what is the volatility regime? Calm contango. So it means that the volatility is still calm, but it's in a contango. So the future prices are higher than the spot price. Okay, and the columns, we have VX1, 2, or 3, which are the duration, which is the spot price, the 3 months, 1 month, 3 months, 6 months, and the CBOE VIX. And we can visualize also the 1 month, 3 month slope, the 3 month, 6 month slope, the overall slope of the term structure, the slope percentile, and in words, what is the term structure of the curve. Okay, so it's very, very useful because we can know, we have some data points that tell us, okay, in beginning of August of this year, just a couple of days ago, the Vix Term Structure is in a calm contango, so like sea waters. So we have some rising waves, rising tide of volatility in the future, but still it's calm, okay? And these are the prices: 1 month 17.5, 3 months 19.6, and 6 months 21. So you see what is the contango, like the short-term price, short-term duration. It has a lower price than the 6-month VIX. So the market expects higher volatility in the coming months. And we have here the 1 month, 6 months difference, slope or spread. Let's call it spread. No, that's the CBOE VIX. Okay, so, okay, yes. So this 95 is the price of the CBOE VIX. This minus 2.09 is the 1 month, 3 month spread. Okay, which is negative, of course, because we are subtracting 17.5 and 19. And the 3 months, 6 months spread also is negative, because, of course, what is the term structure is a contango. Spot prices are lower than the future prices. And these columns, they are also very informative, these data columns. Okay, we have slope and the VX1 percentile and the slope percentile. Okay, so the slope basically is the first derivative change. So we know that the slope basically on average changes by 1.75 unit or 1.75 points per day, and it represents the 46th percentile of the spot price. Okay. And the term structure is, again, contango, calm contango. So with this point of reference, I can see where I'm neutral when there is calm contango, or when there are, we can see here, stress backwardation. So here, for example, it was the 5th of August 2024, so it was exactly this month, the 5th of August, but in the past year, the Vix term structure was in backwardation, but was in a stress backwardation, so very high vol. In fact, the 1 month Vix was 38.5, and then the 3 month 33.7, and the 6 month 30. So we have a short term, there was very high vol in the short term in the first week of August in the past year. Also, the CBOE VIX was 173, and we have a positive spread, term structure backwardation, and the slope was minus 4.1. So that's very useful, because you can you can with almost precision structure your VIX term structure trades according to what is contango, backwardation, the curve, the structure is neutral or is pretty much flat, and you can anticipate big movements in volatility. And if we link together the data, okay, we are in calm contango, and I know that the VIX, if there is high volatility, the VIX can go up in 1 day 10%. Okay, so you make a 10% gain in 1 day if you are long vol. That's what I'm saying. This can be a bit of exotic thing, because volatility is not readily available to any pink panther in the jungle, but long vol, it can be useful. Of course, you cannot be long vol just forever, for a very short period of time, but you need to be it has to be at the right moment. You need to time the market, not almost perfectly, but there is the opportunity, or there is the empirical possibility to understand when to be long VIX, or can you long volatility, or you can structure your trade and you can take some naked call 1 month, few months, or few weeks in the future, so you can basically hedge with derivatives. And that's what ordinary every day hedge funds and investment banks do for a living, like hedging, be long vol, short vol, stuff like that. There are systematic funds which are basically always short vol, and then it's hugely rewarding when you are long vol, because you're going to crush them by 10, 15, 20%, 30% in one day. And those systematic funds, they're taking it on the chin like it's a big knockout punch for sure. IBEX also quite volatile. So we see that on average, we are talking about for the European index, the major European index, the most liquid index, an average of 2%, 2.8%, 2.7% daily drawdown, easy, yeah. Volatility very easy, and the expected shortfall, they are in excess of 3 or 4%. So okay, let's see the FTSE 100. It's a bit less volatile. So it's true that the FTSE 100 doesn't provide yearly return, doesn't provide gains, but here the VAR 95 is 1.60 something percent. It's not 2%. So the basically the large black swan events, probably the FTSE 100 is a little bit more insulated than the all the European, the main benchmark. In Europe or the United States, they are very, very volatile. So it's a bit more, slightly less risky per se, but it's easy, 2% down, no problem. But what is important is that if we see the FTSE, it has 1.6% daily loss, that's already a VAR 95. That's already an alarm bell that we need to keep in mind, because then there can be in the following days, in the following period, there can be more volatility. And then our portfolio savings, our Vanguard portfolio saving, it's a bit of a problem. Euro Stocks 50, okay, easy, 2.15%, almost 3% VAR, and also we're approaching the 10% in the most extreme cases. Let's see, I want to see with you the Nikkei 225, because the Japanese market is the archetype of volatility. Yeah, VAR 95 2.2%, VAR 97.5 2.9%. Yeah, we are in the range, but here, for example, we see that the shape parameter it's 0.28, so it starts to be larger. That means that the weight of there are heavy tails, heavy volatility. It's very, the volatility is heavy. You see here level 99.9%, expected shortfall 12.8%. So that's heavy stuff. If the market tanks 10% in a day, it's out of the ordinary. But easy 2% moving, very volatile, and shortfall 3.5%. So when there is volatility, the Japanese Nikkei 225 it can be treacherous or very profitable, because it's a good market to go long or short, because there is a lot of intraday vol. Okay, and the FTSE MIB, the Italian stock market, also is very treacherous. It's hugely volatile. 99.9%, 11.4% expected shortfall in the most extreme daily losses, like 2020 COVID crash, or I don't know, 2008, not even 2008, that's 2017, I don't know what's that. Brexit, I have no idea, the Brexit disaster. But easy, the FTSE MIB 2.4%, VAR 95, easy. You see the market moving more than 2%. Drawdown in one day, and it's very easy to do. Not August. Okay, so now then we can take stock of some more daily vol. You see here from the year 2000 to 2025, 7-day rolling standard deviation in the DAX, it's 1.3%. It's a bit higher than the 21 days rolling standard deviation. That's 1%, and we have the same measure annualized. Okay, so we are talking about something between 16 and 22% annualized vol for an equity index benchmark, because they are pretty much in the same range. that's the CAC 40, yeah, 16 to 21.5% annualized vol. Right, the Vix, it's another ball game. Annualized vol 113 to 178%. The daily vol, it's the rolling 7 days, it's 11%. So the Vix is incredible. It's an incredible thing. But the normal average equity index, the IBEX, a little bit less volatile also because it's a bit less liquid and less traded. So it's 13.6, 18% analyzed vol. FTSE 100, very low vol. 7-8% analyzed vol, very contained. Euro Stocks 50, 13-14%. So the DAX and the CAC 40, they are very volatile because they are traded more. The Amsterdam index, 13-14% annualized vol. The Swiss stock market, very calm, 6.2 to 10% annualized vol. So for example, you want to be long passive investing on the SMI, the Swiss benchmark of blue chips. It's something that you can put in a portfolio, or if you want to use the ETF, because the annualized volatility is 6 to 10.2%. So you are taking a carry risk, which is not really huge, okay, on a yearly basis. And basically you can expect that the index goes up. So it's a rare case that you can invest in a long index like Swiss. That can be done more or less. Norwegian, it's a bit more volatile but less traded. The Nikkei 225, yeah, average vol 12.5, 16%. And the Nordic index, okay, so the Copenhagen market, the Danish market, lately has been much more volatile, 24 to 20%. That's on average the higher average we got until now. And basically all these Scandinavian indices, they are volatile, but a bit less than the DAX or the CAC 40 or the Euro Stocks 50. You see they are in the range 14-15% or 9 to 10%. Austrian 12 to 15, but it's not so much liquid. And here, for example, we see here the FTSE MIB, the Italian benchmark, is very volatile. 17.2, 25%, 7-day analyzed vol. And here we have a lower triangle correlation matrix, which is very, very interesting, nevertheless. And we have some graphical representation. That's the basically box chart. Yeah. So basically, these are the 12 months of the year, and we can see the average daily standard deviation, and the dots, those are the outliers of the average daily standard deviation that you can expect in a specific month, which can be, we see here 8, which is August. The box chart, the daily vol is very low. It's the lowest in the year because it's the lowest levels. Not the lowest levels of the but it's less for August. Nobody is thinking about stock market. There are low volumes. There is less liquidity, and so basically the box plot, it's pretty much contained, a little bit more than 1% in daily standard deviations. But we can see here how we go to 9 or 10, which is September or October, then the box plot is a bit larger, especially in October. We have some large outliers, and the higher quartile range, it's almost closer to 3%. The outliers, they are even 5%. And we can see here how September, October, November, they are the most volatile, together with February and March, more or less. And as I say, the bulk of the year from April to August, you see the box plot, it goes down, 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 and down. The body of the candle, the interquartile range, it's narrower and narrower and narrower, so it means that there is less and less vol, and the market goes up, up, up. So you have a correction the first 3 months of the year. You go you place your bets in long April, and then come the end of August, basically you sell everything and you wait for the dust to settle, and you do a bit of shopping for Q4 speculation. That's the seasonality in markets, in all markets. These are more technical things, so you can see the daily returns, you can see the trend in daily returns, you can see what is the seasonality in daily returns, what are the residuals in daily returns. So those are more technical things, but nevertheless the seasonality is pretty much the same for all the European indices and for the stock market in a wider sense. Although here, for example, we see here how the CAC in August can be more volatile than the DAX. So there are idiosyncrasies in depends or the economic area. So you are considering is it French equities, is it German equities, is it Italian stocks, is it Spanish stocks, or stuff like that. IBEX, okay. Here we have like in October we have excess the standard daily return standard deviation of 5%. So you can see here that either in October or in March are the most volatile months seasonally for the IBEX, which are the Spanish stocks. Same is for the FTSE 100. Whether in October or March, those are the most volatile months. Even September or November, they are a bit more volatile, but that's because of the seasonal volatility. But the largest outliers, they are in October, or that dot here in March. We are north of 4, almost 5% in daily standard deviation for daily returns. And the same is for the stocks Euro 50. Yeah, October 5% daily standard deviation in daily returns, and the same is March, almost 5%. So we see how the patterns they are pretty much the same. The seasonality, the cyclicality in the market, they are very similar. No matter what index you're going to analyze and choose, they all more or less the flows in the equity market, they all move together. And those flows basically they are, as I say, they can be quarter rebalancing, is options, is the long business cycle, is macroeconomic variables, you have expanding GDP or you have recession, so forth and so on. So the cyclicality of markets. So I have a lot of data, and it would take me at least another couple of hours to go through all the data. The conditional vol, are those useful? Yes, they are useful. We will jump on this because basically we are only trying to assess how persistent is the conditional volatility build up. And okay, we can see here what I'm saying. What are the tail risk in market? So this chart is very easy to understand. You have the distribution of the returns, what is the density of the distribution, and you see here how the blue line goes very squiggling, very fine. But it goes very long to +10 or in excess of -10. So those are the fat tail events, the extreme tail events that we tend to ignore all the time. And here for tail risk, the epsilon parameter, it's a positive, so we have heavy tail risk, fat tail risk. And here, because it's a different technique or equation that goes to measure only the tail risk, it doesn't measure the extreme value theory and all the different VAR levels. You see that the VAR 95, it's big, it's -6.9%. So that's the huge tail risk inbuilt in the market. So when basically you apply the method of the tail risk, you take the, I don't know, we can see here 6,498 data points, which are daily returns. So it's more than 6,000 days of daily return. And then you want to know what is the inbuilt tail risk in the market for each and every index. And the DAX, it has a big tail risk, which is -6.9%. And the threshold is 2.8%. So those are parameters which are very useful to know once you once the market starts to break through some boundaries and say, okay, the market is down today 1%. Okay, ordinary. The market is down today 2.8%. Okay, maybe that's an alarm bell, because we are going into some tail risk in the market, and probably investors, they are going to sell a lot more in the coming days. And then if you are investors and you have money in stock portfolio, you will have to be worried probably. If you are a day trader or an hedge fund, probably you'll be speculating and shorting the market, so you try to make money. And so those are the basic dynamic. We can see here how the DAX and the CAC 40, they are pretty much similar for in terms of threshold and tail risk parameters. Volatility is out of the ordinary, threshold is 14%. So, and you see the tail risk is, it's negative, so volatility works in a different way, in the opposite way. IBEX, okay, pretty much the same. So we see that the modeling tail risk gives us pretty much same parameters levels. FTSE 100, it confirms to be a little bit less risky, but it doesn't generate gains as a passive index investing. Eurostoxx is a bit more volatile, but it's there, 2.7, 2.8 and 7%. That's what it is. And yes, so the tail risk more or less for all, not for all, for the European index that I analyzed with more than 6,000 daily data points, we are around the 2.7% as a threshold. If you breach through that threshold in a market sell-off, then the market probably is in some sort of very tail risk scenario or distress scenario, and basically drawdowns can be quite larger. It confirms again the Scandinavian index, they are less liquid, they are traded less, so the threshold, they are a bit lower. The Nikkei is tremendous. It's tremendous. 2.8%, 7.3%, very large tail risk. It's tremendous. It's like Queen Kong. A punch up with the Nikkei 225. Queen Kong. It's unbelievable. The FTSE MIB. It's FTSE MIB tail risk. It's very similar to the Nikkei 225. So there are similarities between Japanese equities and Italian equities. Okay, so if you are building a stock portfolio, don't put together Japanese stock and Italian stocks, otherwise you risk a lot of volatility. And what else we have? Some other GARCH models for sure. Okay, so here that's another thing which is useful. In which volatility regime we are. Okay, so if we see, for example, that the DAX is down 1.78% in one day, okay, we are in a high volatility regime. And what are the alpha and the beta in terms of conditional volatility parameters? And so we have medium vol. We have also the number of observation that's the model finds in the all 6,498 daily data points, so forth and so on. And so I have another measure to know it is low vol, medium vol, or high vol market environment. So you can basically position accordingly. If it's low vol, probably market is going up. If it's high vol, you can expect the market to go down. And autocorrelation, square returns, how they act with the lag within the conditional volatility measures. So GARCH conditional volatility, what are the volatility regime? Very, very useful model to have. Also to confront what is doing the market every day, and in which sort of volatility framework it's operating the market and all the investors. What is the investors' behavior, basically? So you start to understand also what is the mood of the market. It's a low vol mood, medium vol mood, high volatility mood, stuff like that. Because basically it's investor behavior, it's transaction. Nowadays it's all made by algorithms, but there is also a component of investor behavior. And here we start to have some forecast of volatility, because again, another measure to what is the vol situation in the market. It is low vol, medium vol, or high vol. You can see here what is the mean, the average standard deviation, the number of observation, and 21 days forecast. So we see here very timid up trajectory in the forecast of vol, and we have here a 3-month historical volatility. So it's an average rolling 3-month historical vol. Wow, okay, that's very, very choppy. It's very volatile. Daily mean, okay, because it's not a 3-month historical volatility, so it's not a smoothed 3-month vol, but that's the daily. Okay, and then I have the chart 3-month vol. Okay, so okay, I skipped on this one. Okay, I can see. So we can confront what is the daily choppiness vol with the 3-month smoothed average, and the model gives us a sort of forecast going forward. This timid dash line up. And we see that basically probably have also higher Vix vol, so higher volatility. Okay, so also this interpolation of daily returns with the daily volatility and the 3-month rolling average, it gives us the perspective that we're going to have high volatility in the next month or two. Whoa, let's reconnect. Let's reconnect the thing. Let's reconnect the dots. Okay. So another data point, another model, modeling vol volatility is important when the market's going to be more volatile. August is very boring. It's a boring month. Everybody's on the beach with sunbeds and very nice ouzo and having a very good time, which is the best thing to do. That's another modeling of the extreme value theory interpolated with conditional volatility, so that we can basically see what are the VAR levels interpolated and with conditional vol, which is basically the conditional volatility takes into account the time component, which is important. It's different from the standalone daily standard deviation. Okay, I think we are almost done. So we could be almost done. Okay, Bayesian posterior. Okay, too many things. Let me pick and choose something. Okay, so what I managed to do is basically to have a Monte Carlo simulation, a Bayesian method of estimating the daily return and the sigma, the volatility, and the posterior distribution of the expected mean and vol, and the trace of the distribution. Sorry, I'm tired. So basically, it's an interpolation of all the indices. Okay, you see here alpha, beta, 0, 1, 2, 3. So we are running the Bayesian regression with the DAX, and then it's the data, the daily data of the DAX are interpolated with all the other time series that we inject into the model. Although we have just two cores, two very small model. We're not drawing like 10,000 or 1 million sample, otherwise it would be still running for the next 10 years. And we can see how basically in Bayesian terms of probability distribution, we can see how the average daily distribution changes according to what is the DAX or the IBEX or the VIX or so forth and so on, or the other in the FTSE 100, and how the probability distribution also of the daily standard deviation changes. So when basically the model starts to extrapolate the posterior distribution of the DAX daily returns, how this the Bayesian model for the DAX, how is interpolated with the CAC 40 posterior distribution or the IBEX or the FTSE, whatever it is. And so we start to have some other parameters, and we can see what are the positive mean, the positive average value and the negative average daily returns. and we can extrapolate some sort of correlation between the average daily returns of the posterior mean distribution of the indices. I know it's complicated. It's complicated also for me. Don't underestimate the how sophisticated are these models, because that's another branch of things. We are talking about probability distribution. So is the expectation of a parameter one we take all the observations that we have, more than 6,000 days of data. We take all these observations and we want to have a probability distribution of what are the average, the mean, and the standard deviation that we expect as a parameters. Not ex ante, because ex ante we have the data. But what is the posterior distribution? The posterior distribution is a conditional distribution, because it's that is in Bayesian term. So the posterior distribution, it depends from the ex ante data that we have, and in this modeling we are interpolating all the data that I pulled together, all the indices, so that there is also some sort of correlation between the average daily returns of different indices and the average daily standard deviation. And what are the high density interval between 3 and 97%. So we know what are the range within where we find the parameters that are defined by the model. Okay, so we have also an high density interval range. Okay, so marginal square error for the mean return or the standard deviation. So we have also the measure of the very small error that we find, and crucially the R hat must be 1. So these are, the model fits almost perfectly, but there can be some small errors, and we can see here the tail square error, something like that. I need to revise this thing because it's not my daily material. And so in the end, once the model, the iteration for the DAX works through all the other indices, so we are running the DAX, and the DAX is interpolated with all the other indices that we have seen up to now, the CAC, the Nikkei, the IBEX, the Scandinavian indices, the Swiss market, the Italian market. So we have a measure of what are the mean daily returns, what is the distribution, what is the 95% high density distribution, high density interval, and also they give us the 3% and the 97%, so what are the extreme tail of the distribution. And also we have the betas parameters, which are also very important. One is the persistency of the volatility. That's in the GARCH model. At the moment, I cannot tell you for certain what the alpha and beta parameter correspond in this kind of model. But nevertheless, what do we have? We have in which measure the posterior distribution regression coefficient. You can all read it with me. So basically, in which measure the posterior distribution of the Stockholm Stock Exchange, or the Netherlands, the Amsterdam Exchange equities, the Spanish equities, or the FTSE 100 or the Euro Stocks equities, in what measure the posterior distribution of the average returns of those equities, they are correlated with the distribution of the DAX. Okay, and that's basically the model runs through all the regression. Then you can see it starts with the CAC 40 and interpolates with all the other index and runs through all. It takes some very long time, but nevertheless it gives you a few parameters. Here it's the scale of the DAX here, it's pretty bad, but basically what we have is that, as I said before, the Euro Stoxx 50 is among the index which has a positive correlation in terms of the regression coefficient. Okay, so when we run the regression between the DAX and the Euro Stoxx, we have a positive coefficient, which is a bit more than 1.0 something. Okay, So that's what, in broader terms, and I apologize because I've explained it very, very badly. I know that I'm missing a lot of insights of what this model can give you. But basically, the basic concept is how taking the data that we have, taking the regression of the posterior distribution of the data using a Markov chain Monte Carlo model based on a Bayesian posterior mean distribution. So when we run the regression, for example, between the Euro Stoxx 50 and the DAX, we see that they have a positive coefficient, positive regression coefficient for the 95% high density interval. But that means that those indices, they are correlated with a certain parameter. Okay, so all those bars which have dots above the zero, they have a positive correlation, positive regression coefficient. Okay, which is not a straightforward correlation coefficient, but it's in terms of the posterior distribution. It's a bit more nuanced and sophisticated terms. But these parameters, they are very, very, very important. Believe you me, this stuff has nothing to do with this. I'm sorry, I apologize. That's why I hope you can understand how seeing the chart here is very different from seeing this and knowing all this stuff, because it prepares you to what the market is going to do. It's going to throw at you. It's very, very important. And each and every model of this, it would require like a video on itself. Each and every model of this, I should make a video for each and every model. Probably I'll have to do it in order to go truly into the depth of the models. And no, I cannot show you that. Okay, so let's go to the Vix Term Structure, and we end with the Vix Term Structure. Okay, you can see my short update. We have here the first green arrows. So basically, again, basic, but it's not basic. In simple terms, we know that we have a contango. The term structure, the Vix curve is in a contango. Spot prices are lower than future prices. We know that the slope of the curve is 1.75. So the first derivative effect is 1.75. And so we can start to think forward in how to build, for example, a long vol trade, and say, okay, I want to profit from the high volatility in the market. Instead of sitting at home and say, oh, the market is red, the market is tanking, I want to profit from the volatility in the market. So I want to be long vol, also as a hedge against the market going down. Okay, so we see here how it works. When you start to see the first hints of the Vix curve turning, then that's the moment to start to build the positioning in the next weeks. So you probably want to be long September futures, or you want to be long October futures for taking the Vix contracts. You want to be Vix futures long September contract, long October, even November if you probably, I don't know, it depends. It's not easy. It's not easy like that, because probably you will have to be long September, October. You'll have to short the November future to have a balance trade in that terms, but that's very technical. Also, you can have some long calls, plain vanilla calls, Vix future, plain vanilla calls on the Vix around 25, for example, which is out of the money, September expiry, October expiry. But nevertheless, the market is telling us, the Vix term structure is telling us, be aware that there's going to be higher volatility going forward. The curve is in a contango, and as we see here, calm contango. Okay, that's very important. Calm contango. Okay, calm contango, because here we have the scatter plot, and the calm contango, it has been recorded for 2090 days. Okay, once we take the more than 6,000 data points for 2090 days from the year 2004 up to 2025, the VIX has been in a contango, but what it means, not what it means, what are the percentages? So here, VIX 6-month future, you see here that the price can go up to 30, okay? So that's the term structure vis-a-vis the 1 month to the 6 month, okay? So that's the trading signal, okay? So you have a true trading signal telling you long vol signal, because you are in a contango, and so you start to have the VIX prices going up. What are the range? What is the range? Up to 30. So you can measure, as I was saying, if you see that, for example, the 6 months VIX future is above 30, you could theoretically short that future, because probably it's outside the contango structure, and then you can, that's very risky, that's very sophisticated stuff. But then if we go from calm contango to stress contango, oh yeah, we're going towards 40 in the VIX. So that's, and when we saw here stress backwardation, okay, let's go, you see all the red dots. Stress backwardation is the most volatile setup for the VIX, and also neutral, because neutral, basically you can have some spikes in the vol, but the same period, the past year, stress backwardation. Okay, stress backwardation, you can see it was in April 2025. The first week of April 2025, we have stress backwardation, and the VIX was 45, 46, 52, 40, all the tariff mambo jumbo. Yeah, so you see how the model responds pretty much very accurately, very precise, and it captures precisely what's going on with the VIX, and it tells you, it's very useful to have trades with this kind of modeling, because you know where you're going, you know what are the limits, you know that contango can go up to maximum 30, so you will never buy a 35 call, you buy a 25 call, and you know that probably you are in the right range of, even if it's not, if it's near the money or it's out of the money, you know that probably the delta and the gamma you will gain on a sort of derivative trade of that sort. And I was saying stress backwardation. Okay, stress backwardation, yeah, 5th of August 2024, we have stress backwardation 38.5. So those are the data points which are very interesting. Here we have a VAR model, which is not value at risk, so how the futures interact with themselves, and that's the curve. Okay, that's the actual market curve in the VIX. Short term, it's 17 something, and then the future, 3 months, 6 months maturity, we are north of, level is 22. The last price observed on the 4th of August, the 6 months future contract in the VIX, which is it was 22, the value of the future. And that's very, very interesting. And yeah, here we see the regression line and the slope, and market structure or condition, if it's contango or backwardation. Basically, backwardation can be much more volatile than, paradoxically, than contango. So be aware also this. If you are in contango, you don't try and be a hero and buy an 80 call, because it doesn't happen. So I think that's all for me, and I thank you so much for watching the video. Leave a like, just a huge comment, and I'll see you in the next episode. Enjoy your